I read a wonderful book, and I can't recommend this book enough. It's called 100 to 1 in the Stock Market, and it's written by a guy named Thomas Phelps. And this book actually came out in 1972. So it's about 48 years old, but it's really timeless. And Thomas Phelps is a very gifted writer, and he did a really good job in terms of explaining a bunch of nuances. So one of the things that Nick Sleep talked about was that he said, look, Walmart went public in 1970. And from 1970 till now, which is more than 50 years, the Walton family has held the stock. They haven't sold, they just held the stock. But there have been no public market investors that have held the Walmart stock for this 50-year period, or even a 40-year period, or even a 30-year period, maybe even not even 20 years. You might be able to find some 20-year holders. And so what Nick Sleep asked is that if you owned Walmart stock in 1970 or 1980, what exactly was the facts that caused you to sell it? And it's an important question to try to answer. And the flip side of that same question is that if you owned a Kmart stock, maybe 20 or 30 years ago, what caused you to keep it? So Kmart, on a number of metrics, was a very cheap stock, but it was a business in decline. And Walmart, on a number of metrics, was an expensive stock, but it was a business that was growing and going from strength to strength. So I used to always invest until here with the idea of buying things well below what they were worth and then selling them when they got to full price or maybe a little bit over full price. So buy a dollar bill for 40 cents or 50 cents or 30 cents. And then as it approached a dollar, get rid of it and find another 40 cent or 50 cent dollar. And that's worked quite well. I think at Pabrai Funds, every dollar we started with turned into about $14 in the last 21 years. And that's after fees and expenses. But it's a inefficient kind of treadmill way to go through life. What is vastly better is if you can identify great businesses which have great economic characteristics and very long runways ahead and hold those businesses for a long time without being particularly concerned that they may be somewhat overvalued. If it's a really good business, it will probably get optically overvalued periodically, maybe for a long time. And Nick Sleep, in one of his recent emails to me, said to me, he said that, Mohnish, the best investors weren't investors at all. They were entrepreneurs who never sold. And so the idea is that we should think of ourselves as if we were the founders or the family that owns or runs the business and have the same mindset as them. And as long as the business is improving, as long as the moat is widening, as long as things are getting better, we shouldn't be focused on valuations and such. Of course, if things get egregious, if you're a family who owns GameStop right now, you should have sold a while ago. But beyond that, I think so that's a pretty significant mindset shift for me. But I think it makes life easier. I think the returns are better. The taxes go way down. So I've gradually started making this shift in my portfolio. So just to give you a little bit of the Cliff Notes version of the Nick Sleep letters, is Nick understood this notion really well, that when you find great businesses with great runways, run by great managements, that you take the mindset of an owner and not an investor. So in 2013, when just before he shut down his funds, he was running about $3 billion in capital. And 40% of the capital was invested in Amazon. So about 1.2 billion was in Amazon stock. And then Costco and Berkshire Hathaway made up almost the rest of the portfolio. So 90% of the portfolio was Amazon, Costco, and Berkshire Hathaway. Okay, that's how he was running his portfolio. The UK regulators were giving him a lot of grief, saying you cannot have all this risk in a portfolio with so much money in one position, and that you need to diversify. And it went against every bone in his body because He understood Amazon really well. He did not want to change, even 10 years from now, his Amazon position because he understood that business was exceptional. At that time in 2014, Amazon was $300 a share. Now it's 3,300 or more than that. So what he did with his partner, Zach, is he wrote to his investors saying, look, I'm returning all your capital. I'm shutting down my funds. We've had a good run. They compounded at about 20% a year for 14 years. And Nick and his partner, I'm estimating, got maybe somewhere between 100 and 200 million each from all the fees and gains and such that they had made. And they kept their stake in these three companies. So, for example, if Nick got 100 million, half of it was in Amazon and maybe the rest of it is Berkshire and Costco. And he kept it that way. And you can imagine what that did to his net worth. It's worked out very well. And he pretty much outperformed almost any manager I know of. And he's been driving these race cars on racetracks. He's taking long bike rides. He's go skiing. He's not doing much work. I would say in terms of actual work, I don't know, maybe 100 hours a year or something. So the learning from him was that when you identify and find these exceptional great businesses, which have very high returns on equity, very long runways, very great managers, very deep moats, you go all in. And ideally, you try to find them small, and then it's set it and forget it. And it's similar to what this book in 1972 came out, talks about the 100 to 1 in stock market returns. I think even though the book is 48 years old, I think it's timeless. So I think these were the big lessons for me, which is I was always an investor who said, okay, find an undervalued asset and sell it at full price. Like, for example, when I bought our investment in Turkey, I said, okay, this is very undervalued. We'll have a good run. At some point, we'll move on. I don't think about it that way anymore. We own 1/3 of that business, which means that out of the 12 million square feet, 4 million square feet belongs to us, my fund investors. I like that business. The managers are really good. And we will keep that business for a long time. And so that's a completely different mindset from what I had before when I was trying to do these precise calculations of intrinsic value and all of that. We're not doing that.
Most investors treat stock like lottery tickets. They buy something today and hope it magically doubles tomorrow. But the greatest investors in the world think differently. They consider owning a stock the same as owning a business. You're not buying flashing price movements on a screen. You're buying a piece of real company with customers, products, leadership, and growth potential. If the business does well, the stock has no choice but to follow. Once you start thinking like a business owner, something changes in your investing style. You stop caring about small day-to-day fluctuations, and you start caring about long-term execution. A 50% return or even 100% return might sound big, but investors who stayed focused on great businesses know that 25x, 50x, or even 100x returns are possible. And those returns don't come from trading. They come from owning a great business long enough for compounding to work. You don't need tens of those. You don't even need 5. One such stock, just one, is enough to change your financial life forever. So don't just buy stocks, own businesses. Because if the business performs, the stock will do the rest.
Nick Sleep, in one of his recent emails to me, said he said that, Mohnish, the best investors weren't investors at all. They were entrepreneurs who never sold.